Have you ever wondered how an insurance trust works? Hi, I'm Marvin Chong, your professional estate planner. Today we're going to talk about how an insurance trust actually works. And if you've watched my previous episode, we talk about the types of trust, what basically a trust is. So there are many types of trusts available in the market. For example, insurance trust is one of them. And then we have cash trust, we have property trust, we have business succession trust. But today we're going to focus on the insurance trust. So how an insurance trust works? An insurance trust is where we create a trust, and the trust is funded by insurance policies. These insurance policies are advisable to be life insurance policies and have a minimum life insurance coverage of at least 500,000. Then it will be more viable to create a trust. So how does it work? We, as the settlor, the person who wants to create the trust, will need to assign the life insurance policies to the trustee. And these life insurance policies, the life assured must be ourselves, that means the settlor. And second, we will need to draft out a trust deed. So the trust deed will specifically write down the instructions of how we would like to distribute the insurance proceeds. And upon our demise or total permanent disability, TPD, the money will be paid by the insurance company to the trustee, and the trustee will follow the instructions written in the trust deed and distribute it either to ourselves. In the case of TPD, we can use that money to take care of our own self first, and during the demise of the life assured, the money will be distributed to the beneficiaries stated clearly in the trust deed. Let me share with you some of the examples of the instructions in a trust deed. If a person, a breadwinner, a man who is married and has a wife and also a few children, he can instruct the trustee to pay these proceeds from the life insurance policies to his children to pay for their education, to pay for their living expenses, especially if they are minor children, which are child below 18 years old. And secondly, he can pay for his spouse living expenses as well, and including also his parents, depending on the preference and the needs of the person. On the other hand, he can also use part of this money, for example 20% to 30% of his proceeds from the insurance in the trust, to pay for his estate. So he can actually use this money to cover his estate so that it is easier and more convenient for his family members or the executor of his will to execute and distribute his assets in the will. Furthermore, he can also use this money in the trust to do charity. He can use a small portion of this money to donate to charitable organizations of his choice. And the benefit of having an insurance trust is it will help us save a lot of time, because the insurance payout will usually take 1 week to a month depending on different situations, but generally it will be very quick payout by the insurance company, and the execution of the trustee is quick as well. So the payout from the money which was paid by the insurance company to the beneficiary actually takes a very short amount of time compared to executing a will. So our family members will be able to receive the proceeds from the trust in a short manner. That will help to cushion the impact in the event a breadwinner passes away. So there you go, that is how an insurance trust works and how it can benefit you. If you find this video helpful and be of value of you, help to share and like this video, and I'll see you next time.